Just explain to us, it's a slightly different language with property, linked units as opposed to dividends and shares. So just set the scene for us and what these numbers actually mean.
Okay, basically I think the most important number is the distribution, 31.5 cents, which is on target in terms of our prospectus. The difference between a property company and a normal company in terms of dividends is we really pay interest on a debenture. So it's a linked unit is a debenture plus a share, the bulk of it being in the debenture, and it's variable rate. So in essence, you pay out all of the income to your unit holders, and tax is payable by them as opposed to the company.
It's the best explanation I've ever heard of it, so we must make sure we note that down. Okay, so what do those numbers mean, and what does it reflect about the underlying performance?
Look, it's quite a difficult year to compare because in December we unbundled just under 2 billion rands of property to a new company called Arrowhead. So, but if you look at it on a like-for-like basis, we've grown our core income by 6.6% for the half year, which is satisfactory. It's in line with or better than a lot of the other property companies are doing. But it's still hard to get your head around it when 3 years ago we were doing double digits. So it's tough out there, but we're making progress. We're restructuring our business, our portfolio, and we're making good strides in that regard. So quite a different business than it was, say, 2 years ago when we had 400 properties. We now have 250. The average size of the property is about 80 million, where it was 50 million. So a very different business in terms of the way we approach things. Costs, big problem for us, rates, electricity, those kind of things.
In fact, before you go, move further on there, the 400 to 250, the last time you and I chatted, you talked about how you were actually deliberately getting out of certain areas away from the big cities, and there was a deliberate comment about services and so on.
Yeah, I think that what we said was we were going to exit those municipalities where we felt there was corruption or inefficiencies. We've largely, not completely, but we've achieved that. 90% of our portfolio is now in the Western Cape, KZN and Gauteng, which is where we want to be. We still have some properties in areas where we don't want to be, and that's just a process. But yes, we're not going back into those areas.
One of the phrases you use, you say the operating costs, you mentioned costs a moment ago, 25.6% of contractual rental income as a ratio. It'd be interesting to know how good or bad that is. And you say mainly reflecting full period efficiencies arising from the internalization of property management. Sounds a bit jargonistic. What does it mean?
Okay, we're quite fortunate. The numbers look actually better than they are because just over a year ago, we used to have our property management outsourced. We brought that in-house, and we've saved, or will save in a full year, about 35 million rand. So we've brought our expenses down. Our expenses are about 500 million a year. So, 1% of that is 5 million. You save that. You don't see the full impact because things like rates and taxes, electricity increases. If you look at it, we've only grown our expenses 3.3%. But that's distorted by the fact that we made this big saving. I just saw the proposed Johannesburg budget before I came here. With the increase now, rates will on average be for an office block like the one we're sitting in, 35 rand a square metre. It's high.
Reading through your numbers and the statements about that, there's a lot of corporate activity being going on. You referred to it earlier. There's foreign, there's local. Give us an idea of the difference it's made.
Yeah, look, I think on the local side, the corporate activity is largely in regard to Fountainhead. We've spoken about that before. We're now in the hands of the regulators, waiting to see and get the approval for that before we can proceed any further. From an offshore point of view, we did corporate activity about a year ago. We took over a company called Witchford, reversed into that. When we did that, and there's been a lot of market speculation about that because the biggest challenge to Redefine International is the renegotiation of its debt, which is not with bankers, it's in CMBS structures. And when we bought Witchford, in essence what we got 45 million in cash, 3 or 4 unbonded properties, and we knew there was this huge mountain of 300 million of debt that had to be restructured by October this year. But in essence, because, and we don't have that in South Africa, the big difference is all of that debt is non-recourse to the company. Every property is a standalone. So we have optionality. what we can do is say to the service providers, because this is all ex-Lehman Brothers, we're going to keep these properties and pay the debt, and the rest we're going to walk away from. Reputationally not the best thing, but certainly from an economic point of view, we saw it as an opportunity. Some people see it as a threat. We see it as an opportunity, because we'll have a smaller portfolio. We'll take out those properties with nice lease profiles, government tenants, etc. And then we're happy to pay for the others, but certainly not when they are below market value is below the debt, and we'll make offers for those, and then they can take them or leave them.
How do you see the balance between the South African operation and the international operation? Where do you want to be?
At the moment, it's about 10% of our earnings, international. We've always said, sort of 15% of our total assets. Right now, it's about 5% of our total assets. Australia's done very, very well for us. That's been a fantastic investment. The UK is going through very tough times, and all credit to our people there. We back people. Their occupancies are 95%. They've produced what they said they were going to produce. Quite honestly, we think we've got it tough here. It's like a bed of roses compared to what goes on there. But they're doing a great job.
Interesting. Bonds. You went into the bond market in September 11. We talked about that before. It's more than a year now since that. That experience has been good? Excellent
for us. We up until then we'd had 100% of funding from banks. We went into the debt market first with some corporate paper. That's 90-day paper. It's been rolled twice. Our all-in cost on that just been rolled again is about 5.8%. Then we did a 3-year bond, and we got an all-in rate there, a margin of 140 basis points, which takes us to 7%, substantially cheaper than bank debt, and that's going to impact going forward on our average cost of debt. And I would like to do sometime this year maybe another 500 million, as we have a need, maybe on 5-year paper, and see what kind of pricing we get for that.
A year from now, what are you going to be saying?
Well, a year from here, what I'd like to be saying is that we are performing better than our peers. That's what I'd like to do. It's tough, as I say, and one of the biggest issues we've got, it's hard. If you look at our detailed numbers, you'll see that we've only increased rentals on renewals and new lettings by 4%. Well, it's better than going backwards. But 4% is certainly not shooting the lights out when you've got escalations of 8%. So we'd like to see that go, and I'm hoping that, this is not scientific, we haven't done budgets, but I would certainly like to see our growth a year forward at least at 7% over where we are at the end of this year, and just keep delivering. And as I say, if we can get to grips with some of the imposed charges, cut our electricity bills, we've employed a full-time electrical engineer, so we can try and, because you have to be a rocket scientist to understand how electricity is built.